So there are four types of loan: balloon payment loan, interest-only loan, constant amortization loan, and constant payment loan, which is the most common one. I explained the first three types in previous videos, and in this video I'm going to explain the constant payment loan. Now let's work on an example and see how we can apply the loan calculation, how we can apply these principles and calculations to a project with borrowed money. First, let's assume the simple case that there is no borrowed money. Consider an investment of a project that requires a capital cost of $1 million. The capital cost is depreciable over four years using MACRS 3-year half convention. The machine is going to generate annual revenue of $625,000, and the operating cost is going to be $220,000 from year 1 to year 4. The discount rate is going to be 10%, and tax will be 4%, and we are going to consider the working capital of $100,000. So we summarize this example as in this slide. The project life is 4 years, capital cost $1 million, annual revenue $625,000, and operating cost of $220,000 from year 1 to year 4. Depreciation using MACRS 3-year half year convention. Zero salvage. Working capital of $100,000. Income tax is 40%, and discount rate or minimum rate of return is going to be 10%. So we draw our table. First, we enter the revenue of $625,000 from year 1 to year 5. Then we deduct the operating cost of $220,000. Depreciation, we multiply the capital cost of $1 million by the depreciation rates that we read from table 1 from IRS website, and we enter the depreciation from year 1 to year 4 here. The other item is working capital write-off. This is tax deductible, so we enter that with a negative sign. $100,000 we deduct it from revenue as tax deduction. Taxable income, which is the summation over each column. Income tax of 40%, and net income. Then we add depreciation, add back the depreciation, which equals to this row but with the positive sign. Then we add back the working capital write-off because it was deductible from revenue as tax deduction, so we need to add that back again with the positive sign. Then we start adding the costs and capital costs. So working capital of $100,000 at present time with a negative sign, and capital cost of $1 million at present time with a negative sign. We calculate the after-tax cash flow and rate of return and NPV of the project as 11.33% for rate of return, and NPV at the discount rate of 10% of $30,492. Now let's assume the investor takes a loan of $1 million at time 0 with annual interest of 8%. That has to be paid over 4 years. So the first step is calculating the equal annual payments. We use the capital recovery factor, or A over P factor, 8% and 4 years, and we calculate the annual payments of $301,921 that has to be paid for each year from year 1 to year 4. Then we need to calculate the interest and principal portion of each payment for each year. Payments are equal from year 1 to year 4. For year 1, we have to calculate the interest. Interest equals balance multiply interest rate. Balance of $1 million multiply interest rate of 8%, which gives $80,000. And then principal equals payment minus interest, which gives us the principal at year 1. And the balance equals the balance of previous year minus the principal that is paid, which gives us the remaining balance. And these are the numbers for year 1. We repeat the calculations for year 2. We calculate the interest as the remaining balance, which was we calculated here, multiplied by interest rate. The principal equals the payment, which we calculated here, minus the interest. And the balance equals the balance of previous year, which is here, minus the principal, which we calculated here. And this is the remaining balance. We repeat the calculation for year 3. Interest equals remaining balance of the previous year multiply the interest rate, and the principal equals the payment, which is up here, minus the interest, which we calculated here, and it gives us the principal. And remaining balance equals the balance minus the principal that we calculated here, which gives us the remaining balance at year 3. We repeat the equation for the last year. Interest equals remaining balance multiply the interest rate. Principal equals the payment minus the interest. And if we calculate everything correctly, the principal in the last year should equal the balance, the remaining balance, the last remaining balance, and it should give us the 0 remaining balance for the last year. So we are going to need these two rows, interest and principal portions of each payment. And let's see how we have to enter them into the table for our calculations. So the revenue, operating costs, and depreciation in working capital are the same. The other item that we have to enter to the table as an amount that has to be deducted from the revenue as tax deduction is the principal portion of these annual payments. So these loan interest is the interest that we paid, that we calculated here. This is the row. We enter this row, the interest row, as the amounts that have to be deducted from revenue as tax deductions. And we calculate the taxable income, we calculate the tax, we calculate net income, we add back the depreciation, working capital write-off, and working capital with the negative sign. So very important point here, because we took loan, we need to enter the principal portion of those annual payments. So the principal portion of the loan that we calculated here, we extract these and we enter them to the table. So these are the principal of loan. Then we enter the capital cost, which was $1 million, and the loan. So here, as you notice that because we take $1 million exactly equals to the capital cost, these two cancel out, but we still keep them in the table. This is because you keep them organized, because there might be cases that your loan might be lower than the capital cost that you need. For example, let's say you're going to take the loan of $400,000 or $600,000. So in that case, you will need the capital cost. Then you will need to write the entire money required for the capital cost, and you will say, okay, I got $400,000 or $600,000 loan for that, and we calculate the rate of return and NPV. So again, note that when we have borrowed money in our project, we need to be very careful. The interest portion of annual payments are deductible from revenue as tax deductions, and principal portion of those annual payments uh, should be entered in the table with the negative sign. So again, you still need to write the capital cost with the negative sign and the loan with the positive sign. If they are equal, they cancel out. But if they are not equal, if the loan that you're getting is lower than the capital cost that you are needing, then they won't cancel out. And so we calculate after tax cash flow, and we calculate the rate of return as almost 90%. And you can see that how the project is leveraged after we took the loan.